If you open your email and find 80 stock and investing emails, you probably have been scouring the internet aimlessly looking for the magical stock. Decades of research have consistently shown that adopting a buy-and-hold stock strategy is more profitable than actively trading stocks or investing in alternative assets such as corporate bonds, real estate, gold, or treasuries. This evidence is based on a comprehensive analysis of market data spanning 30 years. Upon looking at it, 80 approaches does not look like an ideal buy-and-hold strategy. Before investing, ensure you have a clear understanding of your financial situation. This includes having a manageable debt level and an emergency fund in place. Investing and then having to sell is a waste of time. Know your risk tolerance. You need to define how long you want to use a buy-and-hold approach. For example, 25 years for retirement. Strong business fundamentals. Choose companies with solid business models, good management, and a track record of profitability. Competitive advantage. Look for businesses that have a durable competitive edge, such as a strong brand, unique technology, or high barriers to entry. Steady earnings growth. Companies that can consistently grow their earnings over time are typically more resilient and can provide stable returns. Financial health. Healthy balance sheets with manageable debt levels and strong cash flows are indicative of companies that can weather economic downturns. Dividend yield. A history of paying and increasing dividends can be a sign of a company's financial stability and commitment to returning value to shareholders. Market leadership. Companies that are leaders in their industry tend to be more stable and have better long-term prospects. Scalability. Businesses that can scale their operations effectively are more likely to succeed in the long run. Adaptability. Companies that can adapt to changing market conditions and consumer preferences are more likely to thrive over decades. Valuation. Invest in companies that are reasonably valued compared to their intrinsic value to avoid overpaying for growth prospects. Long-term potential. Consider the long-term trends that could affect the company's business and ensure it has the potential to grow and adapt over time. Let's look at some metrics found under fundamentals on a stock screener that can help evaluate a company's business and stock. To determine the best buy-and-hold stock, an investor should consider a combination of individual fundamental measures that can indicate the company's financial health, growth potential, and valuation. Here are some key metrics to consider. Earnings per share, EPS, reflects the company's profitability on a per-share basis and is a good indicator of earning power. Price-to-earnings, PE ratio, helps assess whether a stock is over or undervalued compared to its earnings. Price-to-book, P/B ratio, compares the market value of a stock to its book value, which can indicate if a stock is undervalued. Dividend yield shows the percentage of a company's share price that is paid out in dividends, important for income-focused investors. Debt-to-equity ratio indicates the relative proportion of shareholders' equity and debt used to finance a company's assets. Price-to-sales, PES ratio, provides a sense of the value placed on each dollar of a company's sales or revenues. Price-to-free cash flow ratio measures the stock's price relative to the amount of cash generated after capital expenditures. Dividend payout ratio shows the percentage of earnings distributed to shareholders in the form of dividends. These measures can help an investor understand the company's current financial performance and future prospects. However, it's also important to consider the company's business model, industry trends, competitive advantages, and management quality. By following a buy-and-hold approach, investors have the opportunity to benefit from the compounding effect, which allows their investments to grow exponentially over time. This is particularly effective when taking a long-term perspective, as it allows for steady wealth accumulation. Additionally, buy-and-hold strategies help to minimize transaction costs. Active trading involves frequent buying and selling, which incurs fees such as brokerage commissions and bid-ask spreads. By trading less frequently, buy-and-hold investors can reduce these costs and preserve more of their profits. Timing the market consistently is a difficult task, even for professional traders. Buy-and-hold strategies eliminate the need to predict short-term price movements and instead focus on long-term trends. This approach helps investors avoid the stress and uncertainty associated with market timing. Emotional discipline is another advantage of the buy-and-hold approach. Active trading can be emotionally taxing, as fear, greed, and panic often lead to poor decision-making. By adopting a buy-and-hold strategy, Investors are encouraged to maintain discipline and reduce emotional reactions to market volatility. Be informed, but don't let emotions get the best of you. The market has its ups and downs. Tax efficiency is also a key benefit of buy and hold strategies. Frequent trading generates taxable events, such as capital gains or losses, which can erode profits. By trading less frequently, buy and hold investors can minimize these taxable events and preserve more of their gains. Furthermore, buy and hold strategies promote diversification. By spreading investments across different asset classes, such as stocks, bonds, and real estate, investors can reduce risk and enhance long-term returns. This diversification helps to protect against market fluctuations and provides a more stable investment portfolio. Index funds and ETFs are popular choices. In conclusion, the historical evidence gathered from 30 years of research supports the notion that adopting a buy-and-hold stock strategy is more profitable than actively trading stocks or investing in alternative assets. This approach offers numerous advantages, including the compounding effect, reduced transaction costs, avoidance of market timing difficulties, emotional discipline, tax efficiency, and diversification. Please like and subscribe.